Thank you, Bryce. Can you all hear me? I had a little bit of breaking down there right at the end of your comments, so hopefully that doesn't continue. Let's see if I can get this shared right. Okay, my slides coming through good?
Yes.
Okay, perfect. Thank you so much for the opportunity to talk to y'all today about risk management. Bryce gave you a little bit of my background, so I won't go and rehash anything, but I have had the opportunity to work with a good deal of farms down in the Georgia, Florida area, and it's always one of my very favorite places to visit. So thanks for continuing to support what we're doing here in risk management and looking forward to helping you maybe learn a little bit more about how these tools can work for your dairies today. Um, I think it's important to start with your first question, which people ask me all the time, which is why? Why do I need to do risk management? Why do I need to talk about risk management? Why do I need to think about risk management? And you know, it used to be, I think, there was a time where you could sit back and you could evaluate prices and determine whether or not they were good prices. I know people still try to do this today, but it gets increasingly harder to look at a corn price, for example, by itself, a soybean meal price, for example, by itself, or even a milk price by itself, and really try to evaluate what that means. Because what we're all trying to do on all of our dairy operations is figure out how to pick a profit margin. So the individual prices of each of those sort of components of what goes into that margin, sort of irrelevant. We really want to focus on figuring out how to make it so that we have more revenue than we have costs. And that returns profit. It allows my dairy to grow or change or just continue exactly as it is. And that becomes a really important thing. And what we know about dairy is that there's a lot of volatility in this marketplace. This chart just meant to show you the class three price, which is, I know, only a portion of your milk price, but it is looking at a very long-term trend going back to the 80s of how markets used to be sort of maybe predictable in a way. 3-year cycles became something that people kind of started to rely on, and you saw just, businesses adapt to that sort of volatility. And as we got into the early 2000s, you can see that we really started to see opportunities where prices were much stronger and then all of a sudden much lower, right? This volatility has tightened up. You have huge swings now as markets move high to low, and it makes it very difficult to consistently manage that profit margin. Because while this just shows you the milk price, we know that these same sort of charts are what you're able to look at on the feed cost side of things as well. And so all of this price instability means that we are hindering our dairy farms' best opportunity to be profitable. We know, and I'll talk about this more a little bit later, but we know that risk management tools can help dairy producers smooth out those price swings, protect your network, and kind of long term work to help you achieve the individual goals that you have for the dairies. And I know there's a lot of people that'll say, the market, I can look out and I get an idea of if I'm going to be okay or if I'm not going to be okay based on what the futures market is doing. And I think what's important to remember is that the futures market is not a guarantee of pricing that's actually going to show up on your farm. I know there's a lot going on this chart, but what this shows you is if you go back to Q1 of 2025, and then you sort of had the foresight, maybe 15 weeks before that quarter, to be looking at what opportunities were on the futures market, you can see that in every quarter, every one since Q1 2025, the 15 weeks before future opportunities were better than where things actually ended up. So the dark bar for each of these quarters represents what the pricing opportunity was 15 weeks before the quarter started. And then this sort of like dashed bar, the softer bar, represents what that actual announced price was. And so what this means is that there were times, in the fall of 2024 where people were looking at first half of 2025 and prices looked relatively decent. And then by the time we actually got there, that pricing had dropped quite a bit. Same thing as we looked into kind of what was happening in early 2025. Opportunities for the end of the year looked pretty decent. What we know it happened, certainly those didn't come to fruition. And so, as we continue to look at markets and try to say, well, I see in the futures market that things look pretty good, it is important to remember that that is not a guarantee that those prices are actually going to stay around, right? And I think when we look at especially what's happening in Q4, we're going to talk about this as we get to the close of my presentation here, but there are some price opportunities for Q4, and who knows where Q4 is going to end up. But if it continues to follow the trend we've been seeing, there is a chance that it'll be lower. And so expecting that those futures become reality is a very difficult thing for a dairy producer to do when their primary goal is to figure out how to continue to be profitable for their dairy. What risk management does for you is it allows you that opportunity to be a price maker. So you're looking ahead, you're using those futures indications, you're saying, hey, I see something right now that looks pretty favorable for my dairy operation. I want to take advantage of that price. Take that price, put that back on and make that price my own, right? Put that back on my dairy so that I know what I can spend, what I have opportunity on, what my profit's going to be, instead of just waiting and seeing what that market actually ends up happening. And so, another way I like to talk about this is that at the end of the day, you always have choices about what you can do about volatility, right? So, there are always options. You can, as sit it out. Right? You look at this picture here, you can be the dog. You can sit there and let the skunk come and eat your lunch. And maybe you're comfortable doing that because every once in a while, the skunk doesn't come around and eat your lunch, right? You have an opportunity to eat your own lunch. And that's great. Choosing to sit that out and not take action on that means that you will have years where you'll be okay. And then you will have other years where you will find that someone's eating your lunch and you weren't able to meet those goals that you had set out for your operation in advance. Instead of sitting it out, right, you can also choose to do something about it. And so here again, right, I use this image because you're the dog again, but you've taken action. You've put yourself in a situation here, put on top of the table, right, to take advantage of the snacks that are there because that's something that worked for you at that moment, right? And I think that that becomes a really important way to think about it. Is when the opportunity arises, choosing to do something with that opportunity to protect that means that now you've got that security of knowing that it was there. There might be times where you took a little bit more than you really needed, right? And so think about this dog is likely to have a stomach ache if he eats that entire box of chocolates. However, it's no real harm because the stomach ache goes away. You still were able to benefit from having some sort of sustenance, which becomes really important. And when you think about it on a risk management and a milk price perspective, it's a matter of giving yourself that something to really rely on and to be able to plan for. So that's how I make the case for risk management. I think, there are studies out there, like extensive studies that tell us that risk management works. And it works not just in the commodity space, but with industries all over, right? When you can reduce your income volatility, you take out some of those peaks and valleys, you have more predictable business performance. And that business performance means that your business is going to last longer, do better, kind of outperform your peers. That gives you a really solid foundation. We know, especially in the commodity space, that these markets swing wildly, right? We saw that a little bit just with the class 3 example that I gave you earlier. But you can't actually control what the market's doing. The only thing that you can do is control your exposure to it. And that's how risk management does that. So it allows you to control your exposure to that market, minimize those peaks and valleys, create that more predictability. It doesn't always guarantee you the highest price. This is a really important thing to understand in the grand scheme of risk management on the commodity space. But it does deliver consistent outcomes. And that's what's going to keep your business alive. I also wanted to bring some perspective. We had gone through and done some analysis here at DFA just to take a look at what hypothetical risk management plans looked like. We focused this specifically on the DRP program, which I'll talk about a little bit more of the details around it. But suffice it to say that the DRP program is an insurance program. It just provides minimum price floors. And we had enough data, we've got several years of data, this program's been around now since 2019, to be able to say, hey, what would have happened if people did certain plans? They implemented different plans. Over time, how would these strategies have worked out for them? And so this is a lot of detail. I'm happy to share these in detail if you're interested in them. But basically, we looked at a variety of different ways that people could purchase. And what became really central to the analysis was that we wanted to ensure that whatever it is people were doing, they always did it. So every quarter, they were booking 20% 10 months out, 20% 9 months out, 20% 8 months out, and so on and so forth, right? Or they were booking 100% on the last day available. Whatever it was, they repeated that strategy over and over because that consistency becomes really important. What we wanted to prove was if you can stay consistent in a risk management strategy, what are the benefits to that? How can that help you over the long term? And what we found was that in every instance of a consistent approach to risk management since Dairy RP had been around in 2019, in every plan that we tried, you end up receiving more in indemnity than you paid in premium. So you're net ahead of your friends or neighbors who would have done nothing, right? And the variance of how far ahead you are kind of depends a little bit on what strategy you put in place, a little bit of what your class three, class four price risk was. But this chart is just meant to describe sort of in general what those results were. And so all of these, again, beat out the people that did nothing. So there may have been some months where the people who did nothing didn't have to pay a premium in dairy RP. But the losses that they took in their dairies when markets really crashed were kind of offset all of that. So being consistent in this, even though you're paying sometimes for insurance you didn't need, still is the better return over a really long period of time. And there are other analyses out there across the industry of people that have looked at this very similar thing, both with dairy RP on any sort of fixed contracts, things like that. I think it is important, as with anything, to mention that, like, listen, using these analysis does not mean that it's exactly going to happen in the future, right? Prior results do not mean future performance, but the themes that come through in all of these types of analysis is that consistently protecting your milk price gives you that peace of mind and gives you your best chance to beat those low prices and see net benefits from these programs. So it's just important to think about it of like the having that plan, having something in mind that you're trying to do with your risk management strategy is the best way to help you stay the course, and also give you your best opportunity again to beat those low prices. I'm asked a lot about, what are some things that people should think about before coming into and deciding to do a risk management plan. And I think these are sort of like five of my points that become really important when you're thinking about trying to strategize as a hedge program the right thing for your dairy. The first of which is that these are marathons. These are not sprints. These are long term. Over the long term, you're ending up with a less volatile price. We're not really trying to get quick wins. There are people and brokerage firms and all sorts of opportunities out there who can provide that sort of benefit for you if you're interested in that. But a true risk management service, a true risk management plan is going to give you a long-term strategy that reacts to your individual business needs and helps you take advantage of those market opportunities as they are. It's also important to be consistent in your strategy. And I think I really made this point very strongly, but I will reiterate it because it is the most important point. In the case study that we saw, is any strategy that you do, as long as you're doing it consistently, that's how you end up with the benefits. The worst thing that can happen is somebody trying to be in and out because you're trying to time the market, you're trying to guess of what things are going to happen. Futures are not guarantees. Nobody knows what the market is actually going to do. And so that in and out is going to create actually more risk back to your dairy rather than mitigate it. So be consistent, be deliberate in the actions that you're taking there. And I think this goes along with that, but don't really let emotions cloud your action. A tip that I have found that helps a lot with producers that I'm working with for the long term is sit down and write out what your goals are around this risk management strategy. Like, why are we making these decisions that we're making today? This was a price that works for my dairy. I know it's going to return me $2-ish of profit. I know that it gives me upside opportunity. Like, write those things down because at some point, the market is going to move in a way that's different than what you thought, maybe, or that what you were protecting against. And having that clear plan reminds you that you didn't make the wrong choice. Having a risk management plan that you end up not needing is the best problem to have because that means that markets were a lot better than they could have been. And so your dairy has more and more opportunities as a result of that. So try to be as unemotional as possible, right? When you're thinking about these things. And the way that that becomes easier, in my estimation, and in the conversations that I've had over the years I've been doing this, is that when you really focus on the numbers. So we're going to talk about this a little bit too, building your plan, but it becomes very important to have an idea of what it is that you actually are looking to protect. What are your costs? What are your goals as far as like what sort of revenue targets you have? How much profit do you want to capitalize on? How are those costs changing seasonally or annually? How can we evaluate all that in the terms of what our milk price protection needs to be? All of the real numbers behind it, they do become important. And a good risk management partner will help you figure this stuff out. Like it shouldn't be something that you just like bang your head against a wall on for months and months and months. There are tons of tools out there to help you sort of get to what these numbers are. But having those numbers first ensures that you're putting the right strategy in place. And I think to go alongside all of that is that your strategies really should be appropriate for your individual dairy and for your risk and agile, right? We're going to talk about hard and soft coverage and sort of the differences there, but you want to understand where you are, how you look at these things, what you need for your dairy in order to really put a plan in place that you can be consistent to for the long time. So those are sort of the ideas behind implementing hedging effectively. I think the things that become really important that you kind of want to work with with your risk management teams, either on the dairy or anybody else that you're working with elsewhere, is just to get all of those numbers in place. Understand your cost of production, understand your market, what drives your milk price, where are your actual price risks, how can you understand what sort of mix of classes need to be protected within your risk management strategy. Understanding basis. Basis becomes really important. Definitely on the milk side, we'll talk about that a little bit, but also what's happening on feed and cattle, because those are major additional revenue streams and costs that you have to kind of account for, and that can be protected in a good risk management strategy. Again, you're setting the goals and then you're knowing what's available. And so that kind of gets me through the introductory part. We're really kind of making the case of risk management. I want to shift now and spend the rest of our time just looking at the programs themselves, and giving you a little bit of flavor for all the things that are available and how they can be used sort of together or separately. So we're going to talk about all these programs, and we'll go into them here. I think it's important, and I'll try to make the point as I'm going through here, before you really look at the programs and decide which one works for you, you got to ask some questions, right? You want to sort of understand the difference between what I'll call here hard and soft coverage. So like hard coverage, think of it, it's like it's something that is fixed. So you're buying or selling, right? Something specific. You're straight up contracting. There's a locked in component to that. Okay. Risks to hard coverage would be that you are limiting upside potential on your milk sales because you've locked it in, right? You're also limiting your downside opportunity on feed. When you're buying feed, that's a locked in. At the same time, hard coverage is really beneficial for people who are looking for kind of like instant coverage. They want to know exactly what that price is that day for as long as they want to take it, for their dairy. It allows you to capture as much downside as is available in the market at that time, and it's a really easy strategy to implement consistently. So that's kind of hard coverage. To contrast that, soft coverage are positions that are a bit more flexible. Think about like something in place to catch us, okay? So you've got floors on milk price, which includes like the DRP program, the LGM program, the LRP program on cattle. We'll talk about all of those. You've also got things like maybe ceilings on your feed price, some sort of like cap for how much you're willing to pay, but gives you that downside opportunity. The risk to soft coverage is that, again, they don't give you instant coverage. You don't know exactly what that price is at that time because it kind of depends on if the market moves sort of above your floor or below your floor or anything like that. There's a degree of uncertainty still there. Plus, these usually across the board are going to come with some kind of premium cost. So you do have to take that into account too. But on the flip side, rewards for soft coverage is that it's going to leave your upside open on milk, and leave your downside open on feed. So it gives you that kind of like worst case scenario type level, and then you've got the upside or the downside opportunity depending on what side you're on there. So if you think about those things, as you think about hard and soft coverages, I want you to think about sort of some of these things that you might be saying to yourself, or things that I hear a whole lot, right? So people will tell me, like, I'll lose my head if I leave money on the table, right? So if I give up any of that upside opportunity in the milk market, I will just go absolutely crazy. Okay, well that's a fact, right? That's an emotion that you have that becomes a fact that we need to consider when we're evaluating what's the right strategy for this particular dairy producer. If you're looking to consistently protect profits, that's another fact. Okay, that gives me some good understanding of where you're going to want to go to. There are people who say, like, it's fine. I don't need to worry about what's in my check each month. Okay, well, that's a fact too. That gives me something that I can help then structure where you're going with that. And people that are just looking for ways to manage their downside risk when things are really, really bad. So the way that a risk management advisor is going to kind of listen to these and help you understand, like, then what's the right fit. I think these are sort of examples. A lot of people are more nuanced than this, but still, if you are going to absolutely lose your head if you leave money on the table, then you've got to look at some sort of soft coverage, because there's never any give up on the milk price in a soft coverage opportunity, right? You've got all of that upside opportunity. If you're just looking to protect a consistent profit year in and year out, the easiest way to do that is some kind of hard coverage. Futures or forward contracting, there may be times when a soft coverage strategy can also provide that, depending on what the market does. So that could be something where you need to be a little agile. If you think it's fun to not know it's going to be milk chicken a month, hey, rock on. There's not a lot risk management can do for you other than maybe advise you to think about it a little bit differently, because it's not super fun at all. And I don't think that anybody really thinks that. But then, of course, if you're looking for a way just to limit your downside risk, that's the perfect mentality for a soft coverage type of approach. So just some things to think about. And you probably have other things that are going through your mind right now as you're thinking about this, like things that, when you think of the idea of risk management have come out for you. Talk that out with somebody that you're partnering with on these things, or just, a friend or a consultant, just to sort of get an idea of like, how does that fit into what kind of risk management strategy I should look at? Okay, as I move into the programs themselves, I wanted to start with the dairy margin coverage program. So, dairy margin coverage, or DMC, right? This is available to dairy producers across the country. It's all available through FSA offices. So you kind of get it locally there. We're going to talk a little bit about how this margin is calculated, but it protects a milk over feed margin of $9.50 a hundredweight, and you can do that on up to 5 million pounds annually for 15 cents a hundredweight. DMC also has monthly settlement, but it is like a delayed monthly. So that means if there's a payment due for January milk, you're probably going to get that in early March. But then you kind of get a rolling monthly payout based on when that margin falls below that 950 level. What you can see on the screen here is just the current expectations for DMC payouts as everything sits with markets today. I think these are as of June 11th. But you can see that there were a couple months that paid out early in 2026. And then looking later in the year, we don't have anything that triggers that 950 level as of right now. Um, you know, the DMC it really is a great program. I got some data from Bryce. He said that about 89% of herds in Georgia are participating in this program, which I'm really glad to see. It is not a specific milk check price. It's not a specific milk farm margin. This is a national average price. And that makes it a little bit tricky because it means it's not a perfect match for any individual farm. But it's meant to kind of reflect like broad national conditions and how those are sort of impacting dairy producers across the country. So the margin is made up of the all milk price. The all milk price is again the national average price received by U.S. dairy producers. So that's reported through AMS. You get that on a monthly basis. It's not your blend. It's not your mailbox. Southeast farms are always, I think always, although I should probably check that, but the vast majority of times going to have stronger milk prices than what that national average all milk price is. Just something to think about. Conversely, now the feed is built based on like the NAS average and national price for corn and for alfalfa hay, and then the AMS Central Illinois soybean meal price. So these are places where, again, when you're looking at Southeast sort of basis numbers, typically basis is a little bit higher here, which means that the feed side of that margin is going to be a little bit stronger in the Southeast. So just places where it's a little bit out of whack with exactly what your costs and revenues are. Still, one thing that I've learned is that DMC is a really important first step in every risk management strategy. It should be your go-to always in risk management strategy on those first 5 million pounds. Regardless of what size you are, this is what you should be doing. And what we know is that since 2018, DMC has paid for itself in all but 2 years. And in fact, it's already paid for itself in 2026, even though we've only got 2 months that look right now like it's going to pay off. It has already covered its cost. So there is a lot of value in this program, particularly for those people who, are under like 250-ish cows and don't have enough milk to really do like major risk management strategies otherwise. This is a great first step program. I want to transition now into the Dairy Revenue Protection Program. I've talked about this a lot because our analysis that we looked at focused on DRP. And this is a program, again, that's been around for a little while. I would suspect that most of you have at least heard of it. But in essence, DRP is milk price floors. So a floor gives you all of that downside protection and all of the upside opportunity. Okay. It is subsidized because it is run through the crop insurance division. It's a crop insurance program. That means that there is a subsidy involved in DRP, which makes it less expensive than like a traditional risk management strategy. It's also really customizable and easy to use. And so what we find is that DRP allows you to utilize class 3 and class 4. And so in all milk sheds, there is some variety of mix between class 1, or sorry, class 3 and class 4, because those are what's driving the class 1 and the class 2 prices, and in essence, that full blend price. So it becomes really important to have both classes of milk in your strategy. In the Southeast, and in Georgia specifically, right, you guys know you are a fluid market. 80+% of your milk is going into class 1. And with the changes in federal order reform last year, class 1 is going to be priced based on whatever's higher between class 3 and class 4. So using DRP allows you to kind of move between those and make sure that you're getting that really effective class 1 hedge. In DRP, just looking at the logistics here a little bit, you can see that on each day, you have the opportunity to purchase a certain number of endorsements. The endorsements tell you what quarter you're protecting, what class you're protecting, what the price is on that day, and then you have the determination of how many pounds you want to do for that quarter. Declared production in DRP is really wide open to whatever works best for your dairy. So you can do 1 pound a quarter, you can do 10 million pounds in a quarter. You just protect up to 100% of what you're going to produce. And just make sure that the reason that that matters, what you're going to produce, is because if a payment is owed to you, you have to submit receipts for at least 85% of that before they'll be able to pay you that indemnity. If you don't make 85% of what you declared to make, you'll still get an indemnity payment, but they'll reduce it down. So just be careful about that. The nice thing though about DRP is because it's so flexible on the production side, you can add coverage over several days, weeks, months, just so long as you keep that total below 100% of what you're going to be at. Logistics on DRP, it is based on futures markets. Okay, so each day we get a quarterly settlement price on the class that you're looking at, either class 3 or 4. And that sets kind of like the underlying price for DRP. And then there's coverage level that tells you how much of that price you're able to protect. And so on this example here, we were looking at a 95% coverage level, which is the highest. That's the most of the price that you can protect. And so an 1806 future settlement means you end up with a 1716 floor. Something else that I've learned over time, so this is another of my lessons from this field as you're thinking about these, is that you don't always need to use a 95% coverage level. For a lot of producers we work with, they do because that gets you the highest possible floor price. But for some people who are looking at getting some kind of like catastrophic break-even protection, or people that have like just really low cost of production, they maybe could look at a lower coverage level. So what you see on this slide is that DRP allows you to do anything from 80% all the way up to 90%, 95%. So if you wanted to do a 90% coverage level, for example, you're now looking at a 1625 floor, right? Because you started with the same futures price, you're only getting 90% of that, but your premium is now much less. So you're only paying 17 cents here. So there's a lot of kind of flexibility to structure that in a way that works for you, and definitely appropriate to use a lower coverage level if that works for your dairy. I just want to talk in essence, right? Because you've got a floor, You are looking at a 1716 floor. There's two scenarios now. And when you go to settlement, the market could settle above where your floor was, or the market could settle below where your floor was. In the event the market settles above where your floor is, that's great. You're just going to pay the premium and go on your way. You had insurance that you didn't actually need. Definitely not the worst thing that's happened to your dairy. If the market settles below your floor, then what's going to happen is they're going to send you an indemnity payment minus the premium that you paid for that coverage. I'm not going to spend a whole lot of time in this particular section here, but I am happy to take questions if there are specifics. But another thing that's important to understand about DRP is that because it is a revenue protection program, there is built into it a yield adjustment. And so they're trying to track how much milk per cow is being generated. They're not looking at your individual dairy. That would be logistically a nightmare to try to track that. So instead, they're using state and region numbers to sort of determine that. So Georgia is kind of like a state in itself. So every day that you're going and purchasing DRP, it comes with an estimated amount of milk per cow that the program believes you'll have in that quarter. And then when you get to settlement, this becomes important because if there ends up being lower milk per cow, that means you actually had less total revenue, right? Because the revenue that you locked in on the day you did your coverage assumed a certain number, like say 6,140 pounds, and you actually only came in at 6,000 pounds milk per cow. And so that means that you needed more dollars out of your insurance. So your payout is going to be a little bit higher. Conversely, if milk per cow is higher in your state than what was expected to be, they're actually going to lower that indemnity because you ended up, in essence, right? The idea behind it is that you ended up making more milk per cow to get that additional revenue. And so that becomes just an important thing to understand. Another thing that I'll mention with Dairy RP that I get a lot of questions about is that everything happens outside of the milk checks. So you kind of want to think about this separately of like what's happening in your milk check is on the right-hand side of the screen here. What happens in your DRP is on the left-hand side. So the market settled lower, which means you're getting an adjustment, a payout out of your dairy RP, but your milk price and your milk check is actually a little bit lower too, right? Because your milk check's paid on the announced price. And so that means that you got to kind of take those dollars out of DRP and put them towards your milk check to help realize what actually happened in that month, but just no physical protection there. Okay, I want to move now into LGM. And again, not spend a whole ton of time here, but I wanted to talk about LGM because this should be, for a lot of you, a relatively newer program to be thinking about. And I wanted to seed the information and let you know that, in the Southeast, as we talked about, specifically in Georgia, right, you're looking at class one markets. And class one pricing is based on whatever's higher between class three and class four. Okay, so that becomes really important. So remember that. Previously, in fact, today, so this change will go in effect on July 1, but previously, dairy producers could not use LGM and DRP in the same months. So, in essence, what that did is it sort of forced producers to pick between using LGM or using DRP. And because of the way that class one mover is going to flip around between three and four, most of the producers that I've worked with have chosen to use DRP as their kind of default insurance program when it comes to milk price risk management because it allows them that flexibility to follow the mover. Well, now starting July 1, LGM and DRP can be used in the same months. And what I think becomes really important is LGM has a monthly settlement option, which means that instead of the quarterly settlement that you have with DRP, now you've got better cash flow protection and a risk management strategy. So when class three is higher, when class three is setting that class one mover, LGM is going to be a more beneficial program for Southeastern producers than DRP. Obviously, when four is higher, DRP is kind of your only option in insurance as far as risk management plans. but being able to move between the two becomes really important. So in today's market, class 4 is still the mover, so DRP is still your best fit. But take the time to educate yourself about LGM a little bit because there will be times when the market is going to switch back. In fact, if you think back to like pre-COVID, class 3 almost always was the leader, right? That was just sort of what we became accustomed to. And so there are some benefits of having a class 3 only program here. Really quickly, just on LGM Dairy, the mechanics, it's again another insurance program. It's not a revenue insurance like DRP is, though. It's a margin insurance. So you're looking at that class 3 milk price and setting a minimum on your class 3 milk price. And then you're looking at corn and soybean meal to kind of be a proxy for what your total feed costs are, and you're putting a maximum on that. So you've got a range in between that's going to allow you the benefit of higher milk prices is great. You get all that upside. Lower feed costs is also great, but you have a minimum margin that becomes locked in. And that is, again, it's a really nice way. Most producers that I'm using or that are using this program are doing it to kind of simulate monthly coverage. Again, the program requires that you have 2 months in each period in there, but you don't have to have the same amount of production. So you could do something like 100 weight and then the rest of the 100 weights in a different month, right? Like you could spread that out in a way that in essence is going to stimulate monthly coverage, which really helpful from a cash flow perspective. Again, it's the same declared production. Think about it the same as we had in LGM in that you can, in DRP, sorry, in that you can protect up to 100% of what you expect to produce. As long as you submit your receipts for at least 80%, 85% of that, you get the full benefit of the indemnity. And then also really important about LGM is that it is only offered on Thursdays. So it's weekly on Thursdays, but it's only on Thursdays. So not something that you get on every single day. You just kind of have to watch and be careful about making sure that you're getting your coverage only on Thursdays. The other piece that comes into play in LGM is that rather than coverage level, remember coverage level in DRP tells you the percent of the futures price that you're protecting. In LGM, they use a deductible. A deductible is how much of that margin you're giving up, right? Of that, you're kind of giving that back. And so there are deductibles that correspond with the subsidy levels. And so the lower deductible, which is the less of the margin you're giving back, the lower the subsidy. So the more cost you're going to have to pay, okay? Whereas the more of that margin that you give back, the more subsidy is there, the more the government covers that cost for you. So kind of like our sweet spot, we like this $1.10 number. A $1.10 deductible is the lowest give up for that max 50% subsidy. So this is another thing that you would want to work with on a risk management advisor, just kind of understanding what's the right fit for you there. Payments all happen again at the end of the period and within which you did it. So I would also just mention for any of you that have some diversification on your dairies, there are LGM programs for cattle and swine that work similarly. You may want to explore those just depending again on what sort of your dairy is structured at. I don't have very many people that have dairy and swine, but you never know. And then I think the last program that I wanted to spend some time talking with you about today is the Livestock Risk Protection Program. And whereas everything else we've talked about to this point has been milk price based, LRP is actually cattle price based. And this becomes a really important revenue stream for our producers to be thinking about because we know, right, where you used to like struggle to get rid of your calves. Now you're talking about $1,800 for a day old. Culls are in the $2,300 range. I mean, just significant revenue that producers are able to capitalize. And so don't let this revenue go away, right? LRP has been around in the industry since 2001, but has recently made some big adjustments to its program to benefit dairy producers specifically. And so Now we have two classes in LRP, again, with dairies in mind. So you've got unborn calves. This reflects the price floor on sort of like your day old beef or beef on dairy cross calves. Anything from 60 to 99 pounds, and they're available, for 13 weeks is sort of the nearby month, going out 43 weeks. So in essence, like she has to be pregnant in order for you to use an LRP program on your unborn calves. But it does give you that protection going out a while. Right now, we're going through April of next year. And then cull cows is the other type that's recently been added, and this actually is expanding starting on July 1. So this is a price floor on your dairy cows that have been removed from the herd and marketed as beef, right? Anything with a live weight of 800 to 1,700 pounds. Right this moment, it's only available 13 weeks out, but starting July 1, this will now be available out up to 52 weeks out. So it gives you a long tail to be able to take advantage of some of these feeder price fundamentals that are creating some really pretty positive returns for calls for our dairy producers. I won't spend a whole ton of time here, but in essence, these programs are most like DRP because they give you that floor. So daily prices, you get the opportunity each day to add a certain number of head depending on how far out you want to go. And then you've got those floors in place based on the market. I think that what becomes really important to understand is that inherent in these programs is what's called a price adjustment factor. And that's sort of a fancy, fun crop insurance jargon term that takes the feeder cattle futures market and translates it into something that actually is relevant for what producers are getting per pound for these types of animals. And so what that means is like in unborn calves, for example, the price adjustment factors are anywhere from 380 to like 400%. And so you start with the futures price. So September feeder cattle futures, for example, are 356. A 390 price adjustment factor means that what's actually happening for these specific beef on dairy calves is that you're getting about 13.88 a pound. That's the insurable price that you're protecting there. And then on a 99-pound calf, which is kind of like your max here for this category, you're then able to protect 13.75 per head. So that's not ever going to match up exactly with what you're getting at your local market. There's always a degree of basis here that becomes really important. Um, but the whole industry, even your local markets, are going to trend based on what's happening in this feeder cattle market. So it gives you that protection against the overall industry movement, and then locally just sort of having an understanding of what that basis is and how that sort of could change locally too. So it's the same thing on calls. The only difference would be that your call adjustment factor is now like less than. So you're looking at a 45% adjustment factor rather than like a 400% adjustment factor. So that same 356 feeder cattle market is really $1.60 a pound on your call. And then on a 1,500-pound animal, you're looking at about $2,400 there. And that's where your insurance would come into play. Again, that $2,400 would be the per head insurance rate for calls going into September. There are some particulars you just want to be aware of about indemnity requirements. There's a little bit more paperwork on the LRP side. So your risk management partner or your agents can help you sort of figure that out. But just do be aware of that. There definitely is more paperwork here than we see on either DRP or LGM sides. And then finally, the last thing I did want to talk about is it's kind of like my catch-all category for everything else that could happen in a risk management strategy. And so you've got futures, you've got options, you've got forward contracts. I know obviously the DFA program offers a robust forward contracting. There are other marketers who offer that. There are tons of brokerage firms and ways that producers could open their own accounts for futures and options trading. In essence, I just wanted to talk a little bit about some of these primary differences that we see. Most of the traditional risk management, like futures and forward contracts, are going to be like hard coverage, right? These are like your fixed. Um, there's going to be some production constraints because when you're talking about full contract sizes, you've got to have a 200,000 pound contract. That's different than what happens in the insurance world, where you've got a lot more flexibility there. There is a limited amount of upside opportunity in the traditional world. And so some of that might come, but you've got to pay for it. Whereas all of the insurance programs are going to be subsidized by the government. So you're still paying a premium, but it's a lot less. Your downside protection, this is where hard coverage typically is better, right? Because you're getting that instant coverage. You're getting that what today's market are is right at that moment. So it's typically the best price. Whereas with DRP, LGM, there's some degree of give up. The coverage level, deductible, those are those amounts that you're giving up in order to get all that upside opportunity. And then from a cash flow perspective too, you get some monthly settlement benefits that come with futures or forwards, again, depending on exactly how you're set up. Whereas DRP, again, is that quarterly settlement. LGM, however, is monthly as well. So still pretty beneficial there. The other thing that I would say in this category that becomes really important is to understand from your partners what other types of things they can protect. You certainly have class three and class four price risk. That's major. That's driving the bulk of your milk check because it's driving that class one price. But you will still have feed risk, you still have cattle risk. There are ways to break it down into additional commodities, things like that. You can sort of break that pieces up as much as you want. And in these sort of futures and forwards type world, you tend to have a lot more flexibility to do that. So worth exploring if that's something that you're interested in with again the partners that you have there. And that is the programs I brought. I just want to close a little bit here with my slide again to remind everybody that futures are not guarantees. There is no reason that because the market was a certain price 15 weeks ago means that it's actually going to end up there. And so I just encourage you to look at futures as opportunities rather than determinants, right? So saying, well, the market looks fine, I'm not going to do anything, that's probably the opposite mentality we should have. The market looks really fine. What can I do to make it so that that market becomes a reality? And I say this because we're 15 weeks out of Q4, right? So for anybody that doesn't have any coverage on for the end of the year, like how can you evaluate an $18 class three price? For a lot of my producers in Georgia, they've got a $3 to $4 basis on top of that, right? Is there some amount of coverage that is beneficial to take that risk off the table and not worry about what Q4 is going to do? Take that price, stabilize it, and make it so that you know. And I know that at the end of the day, like when people don't know what to do, a lot of us just do nothing. And I get that. I understand that. What I would encourage you to do is ask some questions to try to educate yourself a little bit more about what's out there and how it fits for your dairy. Because it is very unlikely that if you change nothing, and you decide not to move forward with any sort of risk management strategy, something magical is not just going to happen to change the course of markets or anything like that. So really encourage you, if nothing else, that this presentation would give you an idea about just asking the right questions, trying to understand a little bit more about what it is that's out there for you, and how you can find a strategy that works for your dairy. I really believe there's something here for everybody. And with that, Bryce, I thank you, and I'll take if there's any questions that have come up.
Yeah, I'm going to cheat and actually throw some questions at you that I received ahead of time from some of our
Great,
producers. So we'll start there.
let's do it.
Um, but first, I'm going to toss in one of my own. Could you reiterate or maybe go more in depth in talking about DRP, how the different coverage levels 95, 90, 85, 80, how farmers can use those to customize their plan and those benefits that come with maybe choosing 80% versus 95%?
Yeah, absolutely. So it really comes down to coverage level is a way to reduce the cost of the insurance. And so I apologize because let me see if I can quickly just flip back to that slide that I think will be a little bit helpful as we're looking at this. Okay. So coverage level is the percent of the futures price that you're protecting. And so the futures price is always going to be exactly the same on each day. So in this example for Q4, you've got an 1806 futures price. So at a 95% coverage level, right, you're protecting as much of that price as the program allows. That means that your floor comes in at 1716. So your effective coverage is now 1716. What you can see on this slide here is that that 1716 is going to cost 34 cents a hundredweight. So, for some producers, that might be totally fine. It gives them what they want. Where I think it becomes important is if, for whatever reason, this 34 cents is not any amount of cost that you want to pay, or the 1716, is a better than you really need price. And so how can I make it a little bit cheaper for myself? Well, now you can come in and say, well, I know that the futures are the same. It's still 1806, but what if I only protected 90% of that price, right? So now my effective class three floor is coming in at 1625 and my per hundredweight premium cost is halved in essence, right? I'm all the way down to 17 cents a hundredweight. So I've got a lot less costs than I'm carrying. And depending on my operation, maybe that 1625 is still like a worst case break even. And I think you could even look at it too with 80 and 85%. Now, in all honesty, Bryce, I think today's examples, this is a harder sell because I don't have a lot of people that can really make it at a 1535 class three. But there definitely are times in the market where because prices are, 18, $19 floors at the 95% coverage level, well, if we could take a little bit less premium there, but still be able to get 16, $17 floors, that's meaningful coverage. And so it's just worth evaluating how much of that futures price you really need based on what costs you really want to carry.
That was really helpful there at the end. So basically, this becomes a much more attractive or workable option the higher those future prices are, and
Definitely.
maybe something you only exercise when you see those forward contract prices way up.
Yes.
Those future prices are higher.
Yep.
We do have some friends from outside of Georgia that have joined today, and will be reviewing the recording as well. So I want to ask. You talked about Georgia in DRP
Hmm.
um, for the production estimate side of
Hmm.
DRP is its own state, so we use a Georgia number. Outside of Georgia, other parts of the Southeast, how is that calculation done? Is it regional? Are there other states that have state specific numbers?
Yeah. So, okay. So in the southeastern states, you've got Georgia, which stands alone, and you have Florida, which stands alone. So producers that are in either Georgia or Florida are going to be driven on exactly just what's happening in Georgia and in Florida, respectively. Now, for anybody else in the Southeast, you're looking at a regional Southeastern price. So it includes in a total number, like a weighted average between Georgia and Florida. So those both are contribute to that pooled price. It's also got North Carolina, South Carolina. I'm going to get this a little bit tripped up. Maybe Louisiana, Alabama. There's a few other states that go in there. Really, quite honestly, if you follow where the milk is, it's driven on kind of the average between Georgia and Florida, right? Because that's where a lot of that milk is. But it's that whole pooled southeastern region. And so it's an estimate based on that whole pooled southeastern region, and then the actual based on what happened in that whole pooled southeastern region.
Okay. One of the questions we received ahead of time was if, as a producer, my primary focus is how much protection can I get for the lowest premium?
Hmm.
Would you say there's certain programs that are more cost effective, more bang for their buck? We use DMC a lot as an example. How would you kind of rate those programs that you reviewed today and kind of prioritize which ones producers should look at if that's their concern?
Yeah, yeah, great question. A lot of people are thinking about this from a cost perspective, and I can't blame them. DMC definitely bang for your buck, 5 million pounds annually, 15 cents. Like, just do that. It's the best deal all the time. Um, I think from an insurance perspective, any of the milk price, like the DRP or the LGM, those are going to be less expensive than your traditional futures and options programs, just because they're crop insurance, so the government's subsidizing them. So that those are sort of the next bucket there. And then quite honestly, the difference between DRP and LGM cost kind of come down to what's happening in those underlying markets. Because LGM is sort of margin based, it's calculating costs based on movements of, class three and then feed and soybean oil markets. As those markets are more volatile, there's tends to be more cost that you're carrying in LGM. And the same thing on the DRP side, as those class three and class four markets are more volatile, you tend to carry a little bit more costs on the DRP side. So they're kind of going to trade off which one's a little bit cheaper or not. Again, just depending on what the underlying dynamics are. I think kind of we haven't done as much data digging on this as we probably could have. The programs have been around for a long time, but in like a last 12-month analysis, DRP tends to be just a teeny bit cheaper than LGM, but not a lot.
Okay. Um, so there's recently been a change to the DMC program with the update from the big beautiful bill um, that has changed the cap on tier one production that can be covered, and I believe I believe USDA has changed a little bit on the rules for how they can buy tier two coverage, and what levels producers can buy tier two coverage at. Have you seen or do you anticipate maybe producers looking more at purchasing more tier two coverage under DMC now? Is that something you would encourage them to take a look at? Maybe buying some kind of catastrophic coverage on the rest of their milk with DMC?
Yeah, yep. That's a great question. And we definitely did see that pick up a little bit in the most recent, because DMC you can only sign up for annually, which is a little bit of a bummer because it just means you have kind of a smaller window to evaluate this stuff on. But definitely, I think that there are some opportunities for additional like catastrophic coverage for your tier two pounds. And I'm talking about like so $4 is the absolute worst case minimum. Everybody gets $4. That's just sort of standard. There's no additional cost for that. You can go to like 4.50 or $5, and those premiums are pretty inexpensive. Like half a penny, I think, is the $5 DMC floor. So that to me probably makes sense. If you're going to do anything, you could do like a half a cent there on your tier two pounds and take your worst case scenario floor up to $1. In the analysis we looked at, it doesn't pay out all that often, right? At the end of the day, the $4 level paid out, I think, three times in history. The $5 level would have paid out one additional time. But that time that it did pay out, it would have covered the full 5 years worth of that half a cent premium. So to me, that makes sense. I have not seen any data that is compelling enough to tell me to go higher than that $5 level. I think the premiums start to get pricey, and then especially when you get into $6 margin levels, those premiums get really expensive. You're back now, I think, in like the 25-30 cent range, and DRP is going to beat that almost every time. Maybe a weird market here or there, but for the vast majority of the time, something you can plan on is that DRP is going to be better there. So if you're going to buy up DMC, really those like first or second margin levels that's all I would put into my DMC strategy.
And our last question is on livestock revenue protection.
Hmm.
A lot of dairies are still relatively new to the world of hedging on their milk check.
Hmm.
Um, this the the check they're getting from the sale yards or for those black calves, those beef on dairy crosses, is now making up a larger portion of the farm's overall revenue. We're seeing, anything. We're seeing anything from $3 to $5 a hundredweight equivalent in revenue coming in off of those calves. So a lot of farms are having a hard time starting the process of how do we determine what kind of coverage we need for LRP. What is maybe some advice you could give on how to start that process, how to start that conversation, and really look at what kind of coverage, what kind of insurance do we really need here?
Yeah. Yeah. I mean, such a great question. And this is, I think, probably over the last 9 months, I've almost had more cattle risk management conversations than milk price risk management ones, because I think producers all across the country are struggling with this very thing. My sort of potentially going to sound a little flippant advice is probably to just do something. We look at cattle in the terms of the fact that it's based on that feeder cattle market. And so when we look at that from a historical price perspectives, like you're touching the top of the market ever. We've all been in commodities long enough that it is unusual for something to stay at the top of the market forever. At some point, this cattle market's going to pull back. And what I think becomes important for producers is less worrying about like the difference between 1200 and 1150 a head, and focus more on the fact that like what if that revenue were to go back to $500, right? How much of that $3 to $5 a hundredweight that you just mentioned, right, have you now come to rely on in your operation? And so really thinking about that and looking a little bit further out too. I think, the fundamentals around the beef market would probably say that we're not in an immediate need to do something in the next like 3 months. But I love the LRP program that goes out 43 weeks on calves and then 52 weeks on culls. I think there is a lot of benefit to be looking further out, and trying to see how we can keep, because the curve right now in the market is still really strong out there. And as more time goes on, when these prices are topping right against the top of the range there, it's just unlikely that they stay there. And so, you know, I understand that it's a new revenue stream, but it's really, really important. And I think just getting comfortable with doing something there. I also find that the LRP program in general it's cost effective, right? You're talking about $1,300 floors for your calves of like $40 a head. So in essence, it's like a 1260 net price. I think when you think about it that way, it makes it a little bit easier to understand taking coverage, especially further out.
Well, Christine, we appreciate your time today and for joining us. If anyone has any follow up questions, maybe after reviewing the recording of this, what's the best way to get a hold of you or the DFA team to learn more?
Yeah, yeah, I should have put my contact info on the slide, Bryce. Sorry about that. So please feel free to give me a shout directly. My cell number is 315-447-5125. You also can reach anybody at the DFA Risk Management team at DFA Risk Management at dfamilk.com. And if there's anything else that you need, Bryce knows how to get me also. So if you have any trouble with those.
Awesome.